Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the wall of worry and the pundits of pessimism. So today is August 2nd, 2023, and I just returned from the Rohan Rec Center here in the Villages, Florida, where I gave this very halftime report to about 300 people. And those of you that were there, it was wonderful seeing all of your faces. Those of you that were not there, we wish you would have been there. The entire team missed you. We know some of you are traveling and some of you are up north right now for these hot summer months. And so we thought we would share with you the presentation so you could see what our outlook is for the rest of 2023 and at the same time what happened during the first 6 months of the year. But before we do that, just to read just a few disclosures, just as a reminder. Nothing that's said here is meant to give specific investment advice. Everybody's situation, their risk tolerance, their time horizon is different. And so this is meant for information purposes only. If you have any questions about anything that I say or that you read during this presentation, please feel free to give our office a call, 352-205-7800. So what's the agenda for today's meeting? Well, number one, how did we get here? How did COVID and 2022, how did that lead us to where we are here? Number two, this year, 2023, where are we and what lies ahead? And what can we do as your advisor and you as a client to make sure that you get the best out of what 2023 has to offer? Let's jump into the very first bullet point, and that is how 2022 led us here today. And I want to start by just sharing this picture of when I was growing up. Tom Price was a bodybuilder and very well known and successful. And you can see from this picture, looking at him, how strong he was. But there was at least some accusations that this was not exactly normal or a normal physique, and that it was possible that there were steroids and other growth enhancement drugs that were used to get Tom Prince to this massive, massive size. And I show this because this is what the US economy looked like coming into 2023. From all the stimulus that the government had provided post-COVID, it made our economy look unusually strong. So remember this picture of Tom Prince, and then take a look at the 20 most important economic indicators coming into 2023. Whether it was monetary policy, US economic outlook, consumer sentiment, disposable income, consumer spending, the labor market, housing, business outlook, corporate profits, inflation, energy costs. This was about as strong as our economy has ever looked. It looked huge and buff like Tom Prince. That was the result of the stimulus in 2020 and 2021. However, coming into 2022, the Fed recognized that inflation had become rampant and had gotten out of control. And so in the spring of 2022, the Federal Reserve, Jerome Powell in particular, began addressing the need to slow down the economy and get inflation under control. And they indicated that they would do this in a methodical way, targeting the economic, the parts of the economy that were seeing the largest inflation. And so we kind of felt like this picture. Uncle Sam's going to target inflation and try to bring it down. And they also seemed to indicate that there would likely be about 3 1/4 point rate hikes in 2022, last year. Well, is that what they did? Well, instead of bringing darts to address inflation, instead, Uncle Sam showed up with a bazooka. And now we know, looking back, that instead of having about 3 rate hikes of 1/4 point, we would have the equivalent of 17 rate hikes to address inflation. Now, what was the effect that this had on the economy? Well, thinking back about Tom Prince and how muscular he was, he got very, very ill and ended up with kidney failure and had to go on kidney dialysis. And if you wonder what happens when you pull all those unnatural stimulants and steroids that made Tom so huge, this is what he went from post body enhancement. The picture on the right. See, that's what Tom Prince should have looked like if it were not for all the steroids. And after having a long professional career, Tom retired from competing. Unfortunately, went into kidney failure while preparing for the 2003 Night of the Champions. Shortly after, he called it quits, and he died at a young age of 54 in February of last year. See, it was not natural for Tom to look like this. He should have looked like this. It was not natural for our economy to look as strong as it was. It was overinflated because of what the Federal Reserve had done and what the government had done in all of their stimulus. Now, just to put the rate hikes into perspective, this chart here shows the previous 6 rate hikes by the Fed, including the 7th line, which was this rate hike. And back and forth, the left to the right shows how many months did the rate hikes continue from the first rate hike, and then up and down shows where the federal funds came from and where it went. And I think the one that it really stands out is in 2015, the Fed began to raise rates. They went up 1/4 of a point and they sat there for a year. And then the following year, they had 3 rate hikes, just a fraction of what they did during COVID, or during last year, I should say, and followed by these rate hikes here. So basically, they went 3 years of raising rates, and they still only got rates up to around 2.5%. Well, in this rate hike session, this cycle, they immediately raised rates, and then they made a huge jump, and they continued to make jumps. And in 9 short months, they had gone from a 0% Fed funds rate to somewhere between 4 and 4.25. Now that's extreme tightening. What did that do to begin with to fixed income? Well, as you can see, the 2022 return of just the Bloomberg rather, aggregate bond index dropped 13%. The 20-year Treasury dropped 31%. Remember, we talk about there being an inverse or an opposite relationship between interest rates and the value of fixed income. As interest rates go up, it drives down the value of existing bonds and other fixed income instruments. And just think about the effect that that had on some of these banks that were sitting on long-term treasuries, and they literally got clobbered. We know, for example, Silicon Valley Bank was sitting with a huge position of long-term treasuries, and then there was a bit of a run on the bank, and they were one of at least 3 banks that failed during this rate hiking session. And the thing is the Fed told everyone that they would be very slow and methodical with raising rates. And now we know, looking back, that the Fed did just the opposite. The Fed was very, very aggressive. And if you were anything like me, no doubt you thought about this classic movie, It's a Wonderful Life, when we saw those runs on the bank.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. Hey, you got any money in the bank? Hurry.
And a lot of people thought about that movie and wondering, is there going to be contagion of the rest of the banking system? We did not think that would be the case. It does not seem to be the case. In other words, this is not 07 through 09 all over again. But the effect that the Fed did in raising rates and trying to pull back on the reins of the economy was that we went from that last picture of the economic indicators that look so positive, and suddenly this is where we were coming into January of 2023. None of them positive, and a sea of red, negative, and neutrals. So it looked like the Fed did their job, maybe even more so than they wanted to, in slowing down everything. This is a good illustration, I think, of the impact across the economy and the financial markets of what happens when we go through a process where we were at near zero interest rates, and all of a sudden we shoot up to about 5% in a year's time. And unfortunately, things don't look a lot better 6 months later. Now, as the Fed raised those rates, it caused almost all of asset classes to shrink back. This chart shows how the Bloomberg Aggregate Bond Index did, how the Dow Jones did, how the S&P did, and lastly, how the Russell 2000 did. All of them negative. One of the worst years, if not the worst year on record for bonds, and the fourth worst year on record for equities. Now, coming into I want you to understand the backdrop of coming into 2023 after this dismal year of 2022, that we had at the last year's, or I should say January's State of the Markets address, we had given some strategists and where they expected the S&P to close this year at. And most of these were pretty low guesstimates or estimates. The highest was Deutsche Bank. They thought that the S&P would end at 4,500, but if you average the rest of them out, they were somewhere in that 4,092 range, and that was by the end of the year. And here we were sitting on July 14th when we added the slide in, and we well surpassed what the group average that the analysts had predicted, and closing at 4505, 500 points or 400 and some points above where many of the brightest minds in the financial world thought that things would end. Now, I'm going to suggest that the analysts were not as off as what the numbers show. And the way that I'm going to suggest that is that if we look at the Fantastic Seven companies in the S&P, that would be Meta or Google, or Facebook rather, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA. Those 7 stocks were up 80.48%. So phenomenal run in the technology sector, even though the S&P was up 18.41. So what was it that drove the growth of the S&P? It was really 7 stocks. Because if we take out those 7 stocks, if we X out information technology and communication services, the S&P was up 5.44%. So it was a pretty modest year for equities. This 18.41 for the S&P certainly does not tell the whole tale. And what we saw was that this was a year that was really driven by the news of artificial intelligence. If you go back to Q3 of last year, artificial intelligence came up on earnings calls just 424 times. Q2 of this year, they were mentioned 1,100 times. So it was really technology and artificial intelligence that really drove the markets this year, the first half. Now, it can be tempting to try to chase those types of returns. And so what we did was we looked back at other investing fads. I guess what I'm trying to convey is it's a cautionary tale of one that could get tempted to get caught up in exciting new investment ideas. And just because those investment ideas have done well, certainly does not mean that they're going to continue. because this kind of irrational exuberance, it happens from time to time. Faddish themes have occurred fairly frequently since the 70s when gold, right here, when gold rallied higher only to trend lower. And these trends can develop in broad markets like Japan and Asia. So a nice run up, but then a subsequent pullback. That was in the late 80s and early 90s. They can also do it on certain sectors like the internet and biotech, like we saw in the late 90s. Housing, we saw that. We know that house prices shot up through the early 2000s and then came crashing back down. What I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by fads. Now, does artificial intelligence offer the potential for meaningful capital growth for investors in the years ahead? It very well may, but there are many ways to incorporate artificial intelligence into investment strategies that takes into consideration your own in particular goals, time horizon, and risk tolerance. Keep in mind that some of the investing fads that people could look at could be considered sectors of the stock market. And because of their narrow focus, a sector investing strategy tends to be more volatile than an investing strategy that's diversified across sectors and companies. Sector investing is also subject to additional risks associated with that specific industry. Sector investing can be adversely affected by political, regulatory, market, or economic developments. So what we're saying is now's not time to jump on the bandwagon necessarily and not stay diversified. Now, what does this mean for investors? Well, it means that the stock market, while it was fairly inexpensive looking at historical data, we look at forward-looking PE ratios or price per earnings. This chart just simply says, are stocks expensive or are they inexpensive? So you'll remember the late 90s, stocks became very, very expensive, trading at about 24.5 times earnings. And then this was the financial crisis of 07 through 09. And after a 57% drop in equity markets and the S&P in particular, stocks became very, very inexpensive. And then they shot back up. And then this was the COVID effect. And then we shot back up again with everything the Fed did and Washington did to reignite the economy, but they caught it on fire. Think about sitting in front of a fireplace that begins to go out. If someone comes in and throws a ton of wood and gasoline on that, it can really make it go crazy and can burn your house down. And that was the fear that what the Fed had done, that possibly it was going to burn down the US economy through all of the high inflation that we saw. Now, if we go back to June of last year when the market hit about its low point, we were trading at around 19.13 times earnings. That was in June of this year. So prices had gone up, they had gotten very, very inexpensive, and now we're starting to see those prices go back up again. So stocks are not as cheap as they were prior, but they're still, we feel, not too expensive. And point two is that when stocks are expensive, they can stay expensive just like they can stay inexpensive for a period of time. And that seems to be what we're looking at right now. So that's what happened in 2022 that got us to this point. But now let's talk about 2023, where we are and what lies ahead. Let's go back to those same 20 most important economic indicators. And you can see that we're still dealing with some real negativity. Monetary policy, the yield curve, interest rates, the leading indexes, or the LEI index, is an index of 10 of the most important economic indicators into one. Negative. Credit demand and availability, negative. Now, one positive. There's one that's hidden by the camera angle here, which would be the geopolitical risk. That's also in the negative right now. So perhaps the most notable indicator is that equity market valuation, this chart right here, or this indicator right here, has not really changed much at all since the start of 2022. And it shows you how the market can look overvalued once again for an extended period of time, as I just mentioned. Now, it's our feeling and the feeling of a number of economists that we follow that it's likely that we do see a recession, that the Fed forces us into one. But there's a case to be made for that recession that is looming, that would be a mild recession. And there's two things that we can look at to see that. Number one, how much in debt or how much in debt payments is the average American paying? And the way they do that is they say, let's take your disposable personal income and how much of that goes to debt payments. Now you can see in the 80s, it was pretty high, 10.6, got very high in 2007, which set us up for the financial crisis at 13.2%. And here we are at 9.7% right now. So we are about at the lowest point that we've been in 40 years rather. So people took the opportunity to pay down debt after the 07 through 09 crisis. Debt has come up, but it's our hopes that that starts to level off. The second thing is people are working. Two lines here. The first line, the light blue line, would be the average American 25 to 54. Their participation in the labor markets, they have a job, and that had continued right until COVID, and then there was a massive, massive layoff, as we know. Lost 30 million jobs in the period of a short few weeks. And then people went back to work. And right now, the highest labor participation rate that we've seen in the last 7 years. Who didn't go back to work were people that were 55 years and above. And I guess that makes sense. COVID scared a lot of them out of the labor market because of health concerns. And if you go into a restaurant or other hospitality and it seems like there just aren't enough workers, here's part of the reason. That there's been an extreme drop, and that has not really changed. And does it change in the future? We're not sure. But as of right now, people that want to work can work, and people that are looking for jobs, there are a lot of them that could go back to work if they wanted to. Now, just as a principle, I want to remind all of you that is the stock market is a forward-looking indicator. The stock market prices in expected earnings and expected conditions over the next 6 to 9 months. And what this chart simply does is it looks at the last 9 recessions. That would be, the recession would be the part in the gray box in each of these graphs. And then what we'll see is that typically unemployment rate starts to tick up right before or during the recession. That would be this purple color. The S&P tends to hit its low point about halfway through the recession, with one notable exception, and that would be the 2001 through late 2001 recession. But for the most part, the stock market hits its low point and then begins to expand halfway through the recession. So if someone says, well, if we're going to recession, the market is going to crash, numbers don't necessarily suggest that, or at least that it can't recover by the end of the recession. We have another graph that will show us that. 5 supportive stock market indicators. Let's take this first one right here. When we have years following a negative year. So last year, 2022, was a negative year for the stock market. In years following a down year, what goes down tends to come back up. The average annual return since 1950 following a down year has been 15.2%. 2 consecutive down years for the S&P 500 is extremely rare, occurring only 3 times in the last 80 years. So generally, when we have a down year, 84% of the time the market is up that following year. The second factor indicator that we look at, which gives us some positive things to chew on, is the January trifecta year. The January trifecta includes years when the S&P 500 generates positive returns during the last 5 trading days of a calendar year, right after Christmas, and the 2 trading years in January. You take that, how did the market do? And if it was positive, step number 1, then they take the first 5 trading days of the new calendar year, number 2, if they're positive. And then the third would be, how does the month of January go? And you might hear somebody say, as January goes, the year goes. When those are positive like they were this year, then the market is up 90% of the time with an average return of 17.4%. During the during the year 3 of a presidential cycle, which is what we're in right now, the S&P 500 has on average gained almost 17%, 16.8, and has been up 89% of the time. And then there's the new bull market indicator. The new bull market, the S&P 500 officially entered a bull market in June of this year, and it took 165 trading days to surpass the 20% qualifier for a technical bull market, marking the second longest period to confirm a new bull market in 75 years. Forward returns after a bull market is confirmed have historically been strong. The S&P 500 has posted an average gain of 18.9%, 12 months after the index cleared the 20% threshold, and has been up 92% of the time. And lastly, the AA2 bull market spread. Now, bearish sentiment has been prevalent over the last year. We get that. We talk to you when you come into the office. We understand that. The bull minus bear spread among the American Association of Individual Investors survey data remained negative for the majority of last year, including over a 2 standard deviation drop in December. Historically, declines in sentiment of this magnitude have served more as a contrarian indicator for stocks, evidenced by positive forward 12-month S&P returns. 12 months later, on average, the market's up 9.9 and is up 77% of the time. So that all is supportive for stocks and their outlook for the rest of the year. Now, remember I had said that the stock market does not necessarily have to drop because we go through a recession. What this chart does is it looks at the last 13 recessions and just simply says during the recession, going back to 1945, was the market positive or was it negative? And interestingly enough, it was positive 7 out of the last 13 recessions. So more than half the time, the stock market has a positive return during the actual recession from the beginning to the end. Now, it can be difficult to stay positive when the market is down like it has been, and the pundits of pessimism and the news are constantly talking about a looming recession. And so that's the reason that remembering the emotional roller coaster of investing is so important. Because when the market starts to go up, people are confident, they feel like really positive, this is great. And then the market hits a peak and everybody's euphoric. This is when people are quitting their job and becoming day traders. But that's really the riskiest time to be entering the stock market on average. Because what goes up can also come down, and then as it comes down, people get nervous, and then they get desperate, and finally, when they're defeated, that's it, and they want to pull all their money out. But just remember, that's really the best time to make money, because the roller coaster says that roller coaster starts to go back up, people get hopeful again, and then they just follow that roller coaster. So where were we coming into 2022? We were here. And where were we in June and then October of last year? We were right here. So should it surprise us that the market is recovering? No, I don't think it should surprise any of us. We can't trust our emotions when it comes to investing, because typically when this happens to be the University of Michigan Consumer Sentiment Survey, go blue, by the way, and what this chart shows is the last times that the consumer confidence hit an all-time high and then an all-time low, and then simply says, how did the stock market do the following 12 months? The 9 times that consumer sentiment has been at the absolute peak, the market averages 3.5% the next 12 months. Pretty staggering. Look at this time, negative 6.2 12 months later, plus 1.2, plus 13, not too shabby. All-time high in the consumer confidence survey, January of 2000, markets down 2% 12 months later. Up 4, down 2, up 29, not bad, and down 1. Look how different it is from when consumer confidence is at an absolute low. So February of 75, it hits a low. 12 months later, the S&P's up 22%. 1980, 12 months later, it's up 20%, up 29%, up 32%, up 14, up 22, up 15, up 43%, and up 17%. You start to see a trend that when making investment decisions, it's important to not go by feelings, but to go by fundamentals. And that's why we're here. We're here as financial advisors to help you make fundamentally right decisions and not let emotions cloud your judgment. So the question is, what can we do or you do in this type of an environment? Well, first of all, Bloomberg Business Week had this cover article of showing where interest rates have gone. Interest rates are finally back up to a more normal level. This is extremely, extremely important because it's been since the Fed lowered rates to 0 in 08 and hardly raised them in December of 08, hardly raised them after that. So what I'm trying to say is it's been 17 years, or 16 years rather, I guess 15 years, as I'm doing this off the cuff, 15 years since we've really been able to get CDs or bond rates that were anything competitive. And we are now seeing some really, really great rates. We're seeing money markets in the mid 4s and CD rates in over 5. And so I think now's a good time to just check out your goals. How much risk do you need to accept in your portfolio if we can go out and get a guaranteed investment for between 4 and 5%? Maybe now's the time to pull back on the risk a little bit and add some more fixed income or CDs to the portfolio now that we have the opportunity to do so. Fixed income does look pretty cheap compared to stocks. This chart shows the yield to worst across fixed income sectors, all the different fixed income sectors. And then they say where the 10-year median amount is and where the current amount is. And I mean, wow, a yield to worst at 4.4 on treasuries and munis at 6. There are some really, really great opportunities. Finally, we're being rewarded for taking on risk, or for being conservative rather in your portfolio with the interest rates that we're able to get at this level. Just a reminder, asset allocation works. This shows when 6-month CDs peak during a previous rate hiking cycle, And what were the 12-month returns of the bond index, the Bloomberg bond index, the high yield index, and the S&P 500? And while this period in the 80s, you'd have been better off being fixed income, now starting here in 90, stocks were very attractive. So in other words, interest rates peaked and the stock market did really well the following 12 months, up 19%, up 38%, down 11, back up 21, and up 8. So what are we trying to show? That asset allocation and continuing to keep equities in the portfolio is still a viable solution. So why do people own equities in their portfolio? I would argue for most people, they're doing it to beat inflation. This chart shows if you would have taken $1 and you would have just, let's say you buried it in the backyard back in 1950, and you pull that up today and you open up the jar and $1 is still in there, $1 from 1950 is has the purchasing power of 8 cents today. Where if we would have taken that same dollar and put it in the S&P 500, it would now be worth $274. So stocks consistently outpace inflation over time. It's also important to remember that time horizon is so important, and to be patient and disciplined. If you came into our office today and you said, here's money, I need that tomorrow, we would never invest it for you, and certainly not invest it in anything that carried risk, because 46% of the time from one day to another, the market's down. However, if you take that same money and you say, I don't need it for 12 months, well, a year, then only 25% of the time it's down. In other words, 75% of the time it's up. In over 3 years, 84% of the time you would have made money. And over the last 5 years, 90%. So if it's a longer time horizon, then that's where risk should be in your portfolio. It should not be, we shouldn't be taking on risk that you need in the short term. Before concluding, I wanted just to remind all of you, just if you get skittish and you're worried about the market and its direction, just remember to consider your future self, because it's very easy to consider your present self and saying, I have heartache, I'm losing sleep, the market has dropped, I want out. But you also have to think about your future self. I've read statistics that have said that if you're a married couple age 65, that there's almost a 50-50 chance that one of you will be alive in 30 years at the age of 95. And so we have to think about your money growing to keep up with inflation and your future self. I think one of the greatest philosophers of our time, if not the greatest philosopher, Jerry Seinfeld, I think he said it the absolute best. Look at this opening monologue.
I never get enough sleep. I stay up late at night because I'm night guy. Night guy wants to stay up late. What about getting up after 5 hours sleep? Oh, that's morning guy's problem. That's not my problem. I'm night guy. I stay up as late as I want. So you get up in the morning, you're warm, you're exhausted, groggy. Oh, you hate that night guy. See, night guy always screws morning guy. There's nothing morning guy can do. The only thing morning guy can do is try and oversleep often enough so that day guy loses his job and night guy has no money to go out anymore.
So when making decisions, especially financial decisions, are we thinking about our future? We're thinking about the effects of inflation and having to carry risk in certain areas of the portfolio that address inflation, but also having money set aside conservative for immediate income needs. And when working with new clients, we put together a strategy for how to deploy money from the portfolio to take care of spending needs, and also thinking about risk and inflation. I know that a lot of times between the two offices, you might only see your advisor or maybe one or two people at the front desk. And I want to remind you that we have an entire team here at Fross and Fross Wealth Management that is working for you. And it's our pleasure to work for you. I think a lot of you know our mission statement, but our mission statement is we realize that clients have unique needs and that they need an advocate. And we feel like it's our job to provide financial confidence through knowledgeable, independent, and ethical advice. Because we're a family and we treat our clients like family. When we work with you, we accept you into our family. So thank you all for being part of our family and entrusting us with your assets. As I mentioned before, if you have any questions about this presentation or simply want to have a review of your finances, please feel free to reach out to our office. We're here working for you. It's our privilege